Welcome back to Investing Talk Podcast.
Good to be here.
Today we're taking a closer look at Senseonics Holdings. They're a medical technology company, really zeroing in on continuous glucose monitoring, or CGM.
That's right. It's a space with a lot going on.
Definitely. We've got a bunch of information here covering their recent performance, financials, competition, future outlook. Basically trying to distill what's most important if you're looking to get up to speed quickly. And hey, if you enjoy what we do, please consider subscribing, liking, maybe commenting. And if you're feeling generous, there's always the option to buy us a coffee. Helps keep the lights on.
Absolutely. Okay, so Senseonics, based in Maryland, their main focus is diabetes management using these CGM systems. The product line is Eversense.
Right, Eversense. And what makes them, noteworthy in this crowded market?
Well, the core thing is their technology. It's quite different. Most CGM sensors, they sit on the skin, need changing pretty often, maybe every week or two. Senseonics uses an implantable sensor. It's put just under the skin, short procedure. And their latest one, the Eversense 365.
365, like the number of days.
That's the idea, that one sensor can work for up to a whole year.
Wow, a year. Okay, that's a fundamentally different approach compared to the competition.
It really is. We're talking potentially 365 days of data from one sensor placement versus, maybe 26 or 52 replacements a year with other systems.
Huge difference in convenience, I imagine. So how is this translating into business performance? What did the recent numbers show?
Looking at Q1 2025, they reported revenue of $6.3 million.
Okay, 6.3 million. How does that compare?
It's up. It represents 24% growth compared to the first quarter of 2024, which was $5.0 million.
24% year over year. That sounds like decent momentum, especially for a med tech company trying to scale up.
It's a positive sign, yeah. And looking ahead, for the full year 2025, management's guidance is for global net revenue somewhere between $34 million and $38 million.
34 to 38 million. And they also mentioned something about patient numbers.
They did. A key goal for them this year is to double their global patient base compared to the start of 2025.
Doubling the patient base. That's pretty ambitious for 12 months.
It certainly sets a high bar for their commercial team.
If we zoom out a bit, what is that, say, $35 million midpoint projection for 2025? Tell us about their growth over the last few years.
Well, if you look back, say, to 2019, their revenue was around $21 million, comparing that to the projected $35 million midpoint for 2025.
Okay.
That works out to a compound annual growth rate, a CAGR, of roughly 10% over that 6-year period.
10% CAGR. So the recent 24% jump is strong, but the longer-term trend has been more steady.
Perhaps steady is a good word. Not quite the exponential curve some tech investors look for initially, but consistent growth while requiring significant investment, which is typical.
Makes sense. How has the market reacted? What's the stock price been doing?
Well, as of early June 2025, it was trading around 53 cents per share. 53 cents. And the key thing here is volatility. The 52-week range is quite wide, from a low of cabocles in 25 cents up to a high of $1.31.
Ooh, only at 25 to $1.31. That's a massive range.
It really highlights the uncertainty and changing investor sentiment around the company. There was some downward pressure recently leading into early June, but volatility is the main story there.
Right. Not totally surprising for a company in this stage, I suppose. High growth sector, lots of competition, still working on profitability.
Exactly. That kind of profile often comes with a bumpy ride in the stock price.
Now, speaking of financials and maybe trying to stabilize things, the materials really highlighted some big capital raises in May. That seems crucial.
Oh, absolutely. A very significant development. They did two things concurrently in May 2025. First, a public offering of stock.
Okay.
That brought in roughly $57.5 million in gross proceeds.
Gross proceeds. Just remind us that that's the total cash before fees and expenses, right?
Correct. It's the headline number, the cash infusion before the costs of doing the deal are taken out.
Got it. So a good chunk of cash. And there was another part.
Yes. At the same time, they did a private placement, selling shares directly to specific investors.
Yeah, and who was involved there?
That raised about $20 million. And the really interesting part is who participated. Abbott Laboratories.
Abbott? Wait, Abbott as in the competitor with Freestyle Libre.
The very same. Abbott bought shares in that private placement.
That's unexpected. A major competitor investing directly.
It definitely makes you pause. Abbott ended up owning nearly 5% of Senseonics' outstanding shares after both offerings closed. They bought in at 0.50 per share.
Okay, wow. What does that signal? Is it a hedge? keeping tabs on the tech, potential collaboration down the road?
It could be any or all of those. Abbott hasn't explicitly stated their strategic intent. From their side, it might be a way to gain exposure to implantable tech, keep a close watch, maybe even see it as a potential future opportunity. It creates this really interesting dynamic competitor and investor.
Fascinating. And for Senseonics, what does this influx of cash mean?
Well, the total from both deals is around $78 million gross. These are major liquidity events. It gives them a much longer financial runway, cash to fund operations and growth.
And doing it by selling equity helps the balance sheet without piling on debt.
Generally, yes. Raising equity strengthens the balance sheet, boosts cash reserves. The recent summaries didn't give exact debt figures, but this move likely avoids adding significant leverage.
So the runway is extended, but are they actually making money yet? What did Q1 earnings say about profitability?
Still operating at a loss. The net loss per share for Q1 2025 was reported as negative 2 cents, $2.
Okay, it's still negative.
But the information indicates this was an improvement. The losses are narrowing. The net loss decreased to $14.3 million in Q1, which is better than before. And their gross profit improved too, reaching $1.5 million.
Gross profit, that's revenue minus the direct cost of making the sensors, right?
Correct. So they're making money on the products themselves, but not enough yet to cover all the other operating expenses like R&D, sales, marketing, admin.
So moving towards profitability, but not there yet. What does that mean for common investor metrics like the PE ratio?
Well, you can't really calculate a meaningful price-to-earnings ratio when earnings are negative. It's just not applicable.
Right.
And that's a key contrast with the big competitors like Dexcom or Abbott. They are profitable, and they trade at really high forward PE ratios, sometimes over 50x. That reflects investor confidence in their future earnings power.
A very different profile. What about other health metrics? Return on equity, free cash flow? Anything on those?
The recent releases we looked at didn't really detail ROE or FCF. For that level of detail, you typically need to go digging into the full SEC filings, the 10Qs, or the 10K.
Makes sense. The summary reports focus on the headline stuff, revenue growth, funding.
Precisely, especially for a company in this heavy investment phase.
Okay, so summing up the financial picture. Growing revenue, improving gross margin, still losing money overall, but just got a big cash injection to keep things going. Sounds like a classic growth stage medtech story.
That's a very accurate description. Burning cash to scale, hoping sales catch up and eventually push them into the black.
All right, let's shift gears a bit. Away from the numbers, more towards the business itself. Their competitive edge, partnerships, where they fit in the market.
Okay. Their core advantage, as we touched on, is that patented implantable tech. The long wear time, up to a year, is the absolute key differentiator.
That patient convenience factor again.
Exactly. It potentially appeals to a segment of the market that really values that discretion and freedom from frequent changes.
Are they relying just on the tech or building an ecosystem around it? Any key partnerships?
Partnerships are definitely part of the plan. A big one mentioned is with a company called Sequel.
Sequel.
Yes. They're integrating the Eversense 365 CGM data with Sequel's automated insulin delivery system, which is called Twist.
Ah, like an artificial pancreas system component.
Kind of heading in that direction. It moves Eversense towards being part of a closed-loop system. They're targeting a launch for that integration in Q3 2025. That makes the CGM data more actionable automatically.
Okay, that's significant. Any others?
They also have a major commercial partnership with Ascensia Diabetes Care. Ascensia handles the distribution and sales for Eversense in many key markets globally.
So, using Ascensia's established channels to get the product out there. Smart. How does all this position them against the giants?
The materials describe Senseonics as a challenger. They're not leading the pack, but they're in the fight. They operate behind Dexcom and Abbott for sure, but they aim to serve unmet needs with their unique long-term solution.
And the overall CGM market is still growing fast.
Oh, very much so. Driven by rising diabetes rates globally and increasing adoption by doctors and health systems who see the value in continuous monitoring for better outcomes.
Okay, so who are the main competitors again? We mentioned Dexcom and Abbott.
Right. Dexcom with their real-time external sensors, lots of data sharing features. Abbott with the Freestyle Libre, the scan-as-you-go system. And Medtronic is also a major player, often integrating CGM with their insulin pumps.
And the scale difference is just immense, isn't it?
It really is. Senseonics' market cap is around $400 million. Dexcom is multi-billions. Abbott is a behemoth multi-hundred-billion-dollar healthcare company.
That puts things in perspective. The resource difference is huge.
Absolutely. R&D budgets, marketing power, existing relationships. The leaders have massive advantages, which again highlights why partnerships, like the one with Essentia for distribution, are so vital for Senseonics.
And brings us back to that Abbott investment again. Competitor, but also putting money in.
It just adds such an interesting layer, doesn't it? Suggests even the big players see something potentially valuable or disruptive in that implantable approach. It's not purely adversarial at all levels.
Okay, let's try to pull the threads together. Based on everything, what are the core strengths identified for Senseonics?
The main strengths highlighted are: 1, the innovative, differentiated implantable technology itself; 2, the strategic investment from Abbott, seen as validation and potentially strategic; 3, the successful recent capital raises, giving them that crucial financial runway.
Makes sense. And on the flip side, the red flags are key risks.
The big ones noted are: 1, the significant stock volatility we talked about, high risk profile there; 2, the current lack of clear, consistent profitability, the path to breaking even isn't fully mapped out publicly yet; 3, and this is a big one, execution risk.
Execution risk. Can you break that down simply? What does it mean for them specifically?
Sure. It's basically the risk that they won't be able to successfully deliver on their plans. Can they manufacture enough sensors reliably? Can they scale up sales and distribution effectively, especially against entrenched competitors? Can they convince doctors and patients to switch to or adopt Eversense 365 at the rate they need? Can they secure good reimbursement? It's all about turning the plan into reality in a tough market.
Got it. Having the tech is one thing. Getting it widely adopted is the real challenge. So looking forward, what should we watch for? Upcoming catalysts or opportunities?
Key things to watch: continued rollout and market uptake of Eversense 365 globally. That's number 1. Any new clinical data validating the tech or expanding its use. And obviously, the quarterly earnings reports tracking revenue, costs, patient growth, path to profit.
And the potential bumps in the road. The risks.
Regulatory hurdles are always a factor, especially getting approvals or broader labels internationally. The competition isn't standing still. Dexcom and Abbott are constantly innovating too. Macroeconomic pressures affecting healthcare spending or insurance coverage could bite. And that execution risk looms large, just delivering on the commercial plan.
Any other specific opportunities mentioned?
Yes, updates on integrating Eversense with other insulin pumps beyond Sequel's Twista. That could broaden the potential market for automated systems. Also, building stronger ties with large health systems could create more predictable revenue streams.
Okay. Taking all that into account, the potential, the risks, what's the general vibe, the market sentiment towards Senseonics right now?
It seems pretty mixed, leaning towards cautious optimism, especially from analysts. Some see significant upside potential. One estimate mentioned was over 270% based on the tech and partnerships.
Wow, that's optimistic.
It is, but it's tempered. That optimism is balanced by caution due to the low stock price, the volatility, and the fact they aren't profitable yet. Retail sentiment seems mixed to excitement about the tech and launches, but also some concern about dilution.
Dilution. That comes from the recent stock offerings, right?
Yeah.
Issuing more shares.
Exactly. When a company sells a lot of new stock, it increases the total share count. So each existing share represents a slightly smaller piece of the company. It's often necessary for fundraising, but it can weigh on the stock price in the short term, and existing shareholders notice their stakes shrinking percentage-wise.
Understood. Okay, let's synthesize. Unique implantable tech. Growing revenue but still losing money. Just raised significant cash, including from a rival. Faces intense competition. Stock is volatile. What's the elevator pitch takeaway?
I'd say Senseonics has genuinely different technology and just got funded for its next push. But it's a David versus Goliath situation. In a tough market, they're not profitable, and the stock is definitely not for the faint of heart right now.
Given that picture, what was the general recommendation suggested in the materials?
The consensus seemed to be around a hold or perhaps a speculative buy.
Okay, hold or speculative buy, why that specifically?
The reasoning is basically, look, the innovation and partnerships offer real potential for significant upside if they execute well. But the volatility and lack of profits mean it's risky. So maybe hold if you own it, or consider a small speculative position if you believe in the long-term story, but wait for more concrete signs of financial progress and strong market adoption before getting more heavily involved.
So the advice for someone interested is essentially, keep a close eye on those upcoming earnings calls, track the Eversense 365 adoption numbers, watch for regulatory news, but be aware of the risks and maybe balance it with steadier players in the space.
That seems like a very reasonable summary of the situation presented. Monitoring progress against those milestones is key.
All right, so here's a final thought to leave folks with. Considering that unique year-long implantable sensor, how much might sheer patient preference, wanting that convenience, that discretion, ultimately drive adoption, potentially even offsetting some of the competitive pressures or financial hurdles in the long run? Can that specific patient value proposition be the trump card that helps this challenger succeed? Something to think about.